Hello and welcome to this special report for crude oil markets. I'm Cristina Bartenido, investment analyst here at XM.com, and at this video we are going to briefly discuss three of the main risks oil prices could face in the next 3 months. The first issue comes from the supply side and regards the output cut agreement between OPEC and non-OPEC members back in December, as well as the excessive production in the US. OPEC and its allies, including Russia, decided in December to cut output by 1.2 million barrels per day, but the latest monthly report by the International Energy Association showed that compliance among non-OPEC members was only 25% compared to 86% in the OPEC group. While this is not something new, a missing targets combined with a rising supply in the US, which is set to reach fresh highs in 2019 and 2020, is likely to put Saudi Arabia at risk of falling short of its spending plans for 2019. According to the IMF, the Saudi government needs prices above $80 per barrel to balance its budget, but with non-OPEC members producing more than the latest agreement requires and US output surging even further, oil markets could face difficulties to drive prices above 80, even if Saudi Arabia and some other OPEC members have already pledged to cut output more than they initially agreed. Moving on, tensions between the US and Iran is another concern. The US imposed a second round of sanctions against Iran in November to force country into negotiations of a new nuclear deal, but Washington hasn't maximized economic pressure on Tehran yet, as the US administration decided to provide a 6-month exemption from sanctions to 8 key countries, including China and India. In May, though, the waivers are expiring and the US will likely look at the oil prices before taking any decision. If crude prices hold below 50, the US is expected to cut the number of grants. On the other hand, if prices increase above 80, unlike US interests, waivers could hold in place for longer. The third and most important challenge is the ongoing trade war between the US and China. While both sides appeared satisfied with the latest trade talks, saying that progress has been made in key areas, they failed to provide proofs of progress. Talks are now moving to Washington, but officials have until March 1st to reach a compromise before US tariffs on Chinese products double. Should negotiations fail to open the way for a constructive meeting between the US and Chinese presidents at some point in March, a fresh sell-off could start in oil markets in fears that a stronger trade war could restrict growth in the high oil-consuming China and therefore demand for oil. Finally, looking at crude prices, WTI managed to touch 3-month highs after OPEC's output cut deal. The market could improve further if developments in the Middle East lead to further supply restrictions or a trade deal finally comes on the table. In this case, we could watch for resistance between 58 and 60 and then higher at 64. On the downside, if trade conditions complicate and tensions in the Middle East allow for more supply, support is expected to appear between 50 and 46, while lower break below 42 would turn the market even more bearish. So that's all from me. Thank you for watching and have a great day.